All right, welcome back. So we are still digging into the Principles of Business CSEC program, looking at the syllabus right now. And the last time we looked at sole trader versus partnership. We're looking at section number one, objective six, describe the various forms of business organizations and arrangement. So today we are going to take a quick look at companies, including private and public limited companies. So today we're going to look at companies, both private and public companies. And once again, this is at a high school level, so we are not going to delve too deep into companies. All right, so let's just get started. Let's just jump right in. Companies. Most businesses operate as companies. Okay. A company is a legal entity and can own property. A company is owned by its shareholders. Shareholders elect a board to run the company. The board appoints managers who handle the day-to-day business. So let's dig into each of them. Most businesses operate as companies. All right, that is true. Most major businesses are companies. So they are registered as such. They're not registered as partnerships or sole traders. They're registered as companies. Point two, a company is a legal entity and can own property. Now, this is a key distinction between companies and partnerships and sole trader or sole proprietorships. Now, in a sole trader and a partnership, like I said before, if something happens in the premises of a sole trader business, then the person responsible for that, for the damages, would be the owner of the business, that specific person. So if it's John Paul's hair salon and someone slips on the floor, then John Paul, they can sue John Paul and take him to court, and then he would have to pay the damages. For a company now, the company is actually a legal entity. So by law, the company is seen as a person. So the company can actually go out and, like let's say, own property. A company can go and buy up a company. For example, Facebook, a major company. Facebook actually went out and bought WhatsApp. Facebook went out and bought Instagram. So Facebook as a company owns WhatsApp and Instagram. Google went out and bought YouTube. So Google as a company, they own Android, they own YouTube, they own Gmail and those things. So companies can actually go out and obtain property. Now, if someone walks into a Microsoft shop and the floor is wet and they slip and fall, do you think they're going to sue Bill Gates? No, they're not going to sue Bill Gates. They are going to sue Microsoft. And Microsoft would be the one who has to pay out any damages that the court sees fit. They're not going to sue Bill Gates. So Bill Gates is not going to be in the court trying to defend Microsoft. It would be a whole team of Microsoft lawyers in the court trying to defend Microsoft. Same thing as Apple. You're going to an Apple store, something happens to you, you sue Apple. Okay? You're not going to sue, well, you know, Cook or one of those, big bosses at Apple. So when you see, like for example, when Samsung had the Galaxy S Note 7 and it started exploding, then people did not sue, the Samsung family in Japan. All right, sorry, in Korea, they sued Samsung. So that's why they say a company is a legal entity and can own property. Companies can enter contracts. You can have a contract with a company. All right, so point three, a company is owned by its shareholders. Now, whereas the sole trader and the partnership are owned by the partners and the sole proprietor, companies are owned by what you call shareholders, not to be confused with stakeholders. Shareholders are people who actually went and purchased shares in a company. And as the word suggests, a share, you get a part of the company, you own piece of the company. So a lot of companies, public companies, for example, are traded on the stock exchange. I don't know, you might have heard about the New York Stock Exchange or the Dow Jones or those kind of things. Those are indexes and those are areas that you can actually trade stocks of companies. For example, in the Caribbean, you have the Eastern Caribbean Stock Exchange, where publicly traded companies in various countries can actually put on their enlist their name and sell ownership, stocks, shares in the company. For example, in St. Kitts, you have like the National Bank. They are owned by shareholders. People actually went and purchased shares within that company. The shares might be cheap, they might be expensive, but you know, each type, the different types of shares also, we're not going to get too deep into that until later on. But companies are owned by shareholders, the persons who actually purchase shares, and so they are owners of the company. Some companies are so rich and are so expensive in terms of shares, they cannot even own enough shares to make any decisions. For example, you have companies like Microsoft and Apple. Like one share of an Apple stock is like 700-800 US dollars, just one share. And there are so many shares out there that if you buy one share, you hardly got to say you can't say anything. You ain't got no kind of say anything. So companies, in order to raise funds, raise finance, raise money, they can issue shares. People in the public can buy the shares and be part owners of the company. So when the company makes a major profit, how much ever your shares are valued, you're going to get paid in what you call dividends. So at the end of the fiscal year, they're going to pay out dividends if they make a good profit, and you're going to get a share of that. All right, shareholders elect a board to run the company. Some companies are so large. They have thousands and thousands of shares out there and thousands of shareholders. So could you imagine a company having so many shareholders and everybody want to run the business? How would that work? Everybody coming into one little office space to try to run the business. Thousands and thousands of people. That doesn't work. So what happens is that the shareholders, you have annual general meetings for these companies, and you can elect a board to run the company. Okay, and the board would then appoint managers to handle the day-to-day running of the business, because the board members don't really have a hands-on running of the business. They don't go in every day to run the business, because these are people who have other jobs outside of that company, the board members. So the board members would select managers who would then handle the day-to-day running of a company, of a business. Okay, so right now, Microsoft, Bill Gates is no longer the CEO, but he's still a member of the board. So he don't really engage in the day-to-day running of Microsoft. What he does is he will advise and do things like that. He's still on the board. He still have shares, so he have a say in the company still. Mark Zuckerberg don't really engage in the day-to-day running of the business per se. All right, but no, Mark Zuckerberg does. I think he's still an active part in Facebook. Yes, he does. But Bill Gates doesn't. So companies would appoint the board of directors would appoint the managers to do the day-to-day running of the business. All right, so you have the shareholders, a large number of shareholders. Then they select a board, a small amount of people who would then select the managers who do the day-to-day operations of the business. Now, companies, paperwork, documents needed for a company registration. Okay, first and foremost, of course, you need to register your name. All right, so you have to search for a name, register the name, because you don't want two companies having the same name out there. Then you have the articles of incorporation. Now, these are a whole bunch of paperwork that state things like the name of the company, where it's located, all the kind of bylaws and rules that governs the company. So the articles of incorporation are the papers that you have to file in order to make the business become a company. So those are the things that would show the name and those kind of things. Okay, notice of address of registered office, notice of directors. So all these are things you have to notify the authorities about, who are the directors and things like that. Then you have the certificate for incorporation, of course, after you would have gone through all the rigmarole, all the bureaucracy, all the paperwork, you get a certificate to show that you can now operate as a company. You can't operate as a company without the certificate of incorporation. This is what says, okay, I'm a company now, I can operate. All right, the bylaws within the company, again, all these are in the whole, all the articles and stuff. The bylaws set out the rules and procedure that governs that company. So as you can see, the paperwork for a company is way more than a sole trader or a partnership. A lot more things you have to go through, a lot more red tape, a lot more bureaucracy, a lot more work has to be done in order for a company to even start operating. Name search, name, registered name, the bylaws, the articles of incorporation, all those things. So a lot of paperwork go into starting a company. Now, companies have certain advantages and certain disadvantages. And here's our word again, liability, but this time you're not seeing unlimited. This time it's limited liability. Limited liability. What is limited liability exactly? Limited liability is, of course, the opposite of unlimited liability. And so the definition is totally different. Limited, as the name suggests, means that there is a limit to what you can lose if the company goes under. Okay, so if you bought, let's say, $10,000 in shares in a company and the company fails, all you're going to lose is just the 10,000 that you invested. That's all you're going to lose. You're not going to lose your house, your land, your car. You're not going to lose the clothes off your back. You are just going to lose the amount of money that you invested in the company. The amount of shares you bought, that's the total of your losses. So that's when you say that's what limited liability is versus unlimited. In unlimited liability that you find in partnerships and the sole traders, unlimited liability means that you can lose a vast amount of things to help the bank to recoup their debts. You can lose your house if you mortgage it, you can lose your land, your care, your assets, whatever collateral you put up to get the loan, you can lose all of that in unlimited liability. But for limited liability, you can only lose what you invested. So if you invested 5,000, that's what you're going to lose if the company goes under. So that's a good thing. That's an advantage as opposed to partnership and the sole trader. Company may own property and borrow money. Okay, we discussed that earlier when we mentioned that the company can actually go out and buy property. So Facebook can buy land, Microsoft can buy an next company. Like Microsoft bought Skype, Facebook bought WhatsApp, bought Instagram, Apple bought Beats. You can buy companies. You can borrow money. Companies can actually go to the bank and borrow money in their name. So, like I said, Bill Gates is not going to go to the bank and say, "Can you get me some money so I can run Microsoft?" No. Microsoft itself can go to the bank and get the money needed to finance the operations. Professional managers run day-to-day business. Remember, we're looking at sole trader, and we were saying that sometimes sole trader and partnership have limited scope in terms of experiences. We say that maybe the sole trader is just one man who went to study accounts, and that's all he knows. He ain't know much marketing, so he don't really know how to do this marketing thing. But in a company now, you have a vast number of individuals who have different experiences. You have a finance department, you have a PR department, you have a marketing department, you have a production department, and all these are staff with people who know about these kind of operations in a business. Need to invest, need for investors to spend time managing. Sorry, no need for investors to spend time managing. Like I said, you bought some shares, you invest in a company. You don't have to worry about that because the shareholders going to select the board going to select the managers, and the managers are the ones who are going to run the day-to-day operation of the business. Again, we go back to Apple. Apple is run by Tim Cook. He's not the owner, he's just the CEO. So a CEO is normally the person who runs these major corporations, these major companies. All right. The next advantage of companies, shares can be bought and sold. Like I said, okay, so let me try to explain the shares thing a little better. So the shares things like this. You want to start a company. You go to a friend or two and say, okay, I'm going to start this company. If you give me $10,000, I'm going to give you some document. Let's say that you invested 10,000 in the company, and that's your stake in the company. That's how shares go. So you can buy and sell shares. Companies that are already established, they still buy and sell shares. Like I said, if you look at Bloomberg or Fox Business News, you see the stock markets. You have the FTSE, you have the DAX, you have the New York Stock Exchange, the Chicago Stock Exchange, the Nikkei, whatever you want to call it. In the Caribbean, you have the Eastern Caribbean Stock Exchange. Now, on these stock exchanges is where you buy and sell shares of companies. So a company want to raise some money, what they do? Hey, I got 10,000 shares here, let's sell some, raise capital. If they want to get back some control over their operation, they can actually buy back shares from other people who have purchased shares before. So they can buy, you as an individual can buy and sell shares. But how you do it is what distinguishes a private versus a public limited company. Private versus public limited company. In a private company, you cannot sell shares on the public stock exchange. You cannot. You can sell shares secretly. You cannot sell shares on the public stock exchange. You can go to investors and say, okay, I have an idea. Can you back me? And they'll give you the money if they want to. That's how private companies operate. So companies like, let's say, I think Twitter and those companies are still private. Right now, Dell Computers is private. Now, companies like that would not sell stocks on the public stock exchange. What they do, they have investors that come in and they would sell shares to private individuals. Public companies now are allowed to sell shares on the stock exchange to the public. That's why they call them public and some private. There are other distinguishing features that we're going to get into later. All right, let's look at some disadvantages of companies now. Some costs in setting up a company, of course. This is a major undertaking, and as such, you have to pay a lot of fees. Taxes are different to partnerships and sole traders, so it's more costly to set up a company. That's one disadvantage, it's more costly. Managers may make decisions shareholders do not approve of. So, like I said, the shareholders might be the ones who own pieces of the business, but managers operate the day to day running of the business. So, therefore, they can make decisions without the shareholders even knowing. They might approve, they might disapprove, but the decision is already made. Lawyers are not allowed to operate as a company. That's why most lawyers are partnerships. That's just how it is. And there are a few other disadvantages. So that's the advantages and disadvantages of of companies. So here I was discussing before the distinction between the private companies versus the public companies. Let's look at it. Private companies. Shares are not offered to the public, like I said before. Financial affairs may be kept confidential. A simple annual return list, directors, address, and other brief details. So again, private companies. Let's look at these 3 points. Shares are not offered to the public, like I said before. You have investors who would invest in the company, and so shares are not offered to the public at large. So you can't just go on a stock exchange and buy shares. Some companies are private, they only sell to private individuals. Financial affairs may be kept confidential. In a public company, you have to disclose all financial affairs to your shareholders, and as such, the public knows about it. Every year they have what you call an annual general meeting or maybe an earnings call where you have to disclose all the plans the company have going forward, the money they made, the money they lost. You have to disclose all of that for public. But for private companies, you can keep all of the financial affairs confidential. You don't have to send it out there in the public. You don't have to tell anybody out there. A simple annual return list, directors, address, and other brief details. So they might have they might publish something, but it's just a simple list. It's not nothing too in depth. No big thick book like some other public companies. So the public companies, on the other hand, the total opposite. Shares are offered to the public. So you can go and buy shares of Microsoft, you can buy shares of Apple, you can buy shares of Google, but you cannot buy shares of Dell and those kind of companies because they are not on the stock exchange. I don't think Tesla went public as yet, and I don't think Twitter has gone public as yet. So those are still private companies. I don't think Uber was. I don't know if Uber gone public or not, but I think it's still private. All right. Shares are traded on the stock exchange, as I said before. A full annual report publishes financial and other information. So you have to disclose certain information for in a public company. You cannot hide from the shareholders. They need to know, so you have to tell them. So advantages and disadvantages of the public company, and then we're going to jump into conglomerates after. So advantages and disadvantages of public companies. Advantages, of course, raising capital by issuing new shares or stock on the exchange. So if a public company is trying to raise some money, all you have to do is sell some more shares. Some shares have different value. Some are more valuable than others. For example, there are some shares that if you own them, you get first preference for dividends and profits. But other shares are kind of watered down, and so you don't really have much say in anything. You just have a little piece of the business. So we want to raise money. Public companies can sell shares on the stock exchange easy like that. Shareholders can buy and sell shares more easily. So in a private company, you have to go and discuss if you want to sell these shares. You have to go back to the family, you have to go back to the owner and say, okay, I might want to sell these shares. And they can actually dictate where you sell your shares because it's their company. But in a public company, man, you can buy and sell shares as you like. When the cost of when the stock goes up, you sell if you bought it cheaper, and vice versa. When the stock start going down, the value start going down, you can sell, 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 sell. Or you can buy, 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 buy when it's cheap if you think it's going to go back up later on. All right, so the market sets a value on the shares and therefore on the worth of a company. This is a key thing to understand here. Now, this can either be an advantage or disadvantages. A disadvantage based on how we look at it. For example, let's look at let's see company. Let's look at Nike. Okay, Nike is of course one of the biggest apparel makers in the United States, and the value of Nike stock took a major hit at first when they decided to have Colin Kaepernick in one of their ads. Why? Because a lot of people were against him, and so because of the bad blood, the value of the Nike stock went down, and therefore the value of Nike as a company went down. Let's look at Apple. Apple is one of the richest companies in the world. Apple has a market cap of close to $1 trillion, meaning Apple is worth valued at close to $1 trillion. At one point, they were actually $1 trillion company. But when the iPhone 10 came out and they realized that the sales for the iPhone 10 was a little sluggish, nobody really wanted to buy it because it was a little expensive. The stock price of Apple took a fall, took a nosedive, and as such, Apple moved from $1 trillion company back down to a multi-billion-dollar company. So the value of the company, a public company, is affected by the worth of the company's stock. Okay, Facebook, a next company. When Facebook had all the issues with the Cambridge Analytica and all the scandal and stuff like that, in the US election and thing like that, the price of Facebook stocks went way down. The value of Facebook went down. So Mark Zuckerberg, the owner of Facebook, his net worth just declined rapidly just because of the bad news about Facebook. So public companies are at the mercy of the market, meaning whatever the market decides the price is of your stock, that's the value of your company. So that can be advantage or disadvantages. So the advantage now is that if you have good news about your company, the value of your stock can shoot right up. All right, for example, when the same thing with Nike, a lot of people after the Colin Kaepernick was signed in the commercial, the stock price actually rebounded and went up because a lot of black people realized, okay, this brother with us, we're going to support Nike, and as such, the good blood helped Nike to rise above all the bad blood. So it can work either way. It can be good or bad. Microsoft, when this is Microsoft beating everybody in cloud computing, the cost of the value of Microsoft stock went up because it's a good thing. Company people like growth, shareholders like to see company growing. Facebook, on the other hand, right now, a lot of people stop using Facebook, so the outlook for Facebook is kind of grim. Their saving grace, of course, is Instagram and WhatsApp. All right, disadvantages: public companies must publish full financial information. Some owners prefer to keep this information private. Other companies may buy shares to take control in a takeover bid. Now, this is a major disadvantage. Remember, I said that the stocks are available to the public, which means anybody who rich and got money can buy so much shares in a company that they can actually have a commanding say in how the company is operated. Sometimes we call it a hostile takeover, where somebody secretly buys up a lot of stocks in a company and they end up having a commanding say in how the company is operated because the stocks are there to be purchased. That's how some companies they take over other companies because they go out and buy a lot of stocks of that company so they can have a commanding say in that company. All right, and so that pretty much covers what you need to know about companies. Like I said, it's not too in depth. You have a lot more information that you can go into. So these are some little notes to be mindful of. Private company was one with fewer than 50 shareholders. Under the farmer system in the Caribbean, documents needed for a company were memorandum of association and article of association. Those are the old time things. Okay. Before we move on, let me just tell you a next distinguishing feature of a private versus a public, a very easy one to remember, is that when you see a company mark LTD, limited company, that's a public company. So if you see Johnson and Johnson Limited, that's a public company. If it's PLC, that's a private company. Okay? So LTD in the name of a company, that's public. PLC in the name of a company, that's private. Okay, so keep that in mind. Those are other distinguishing features, including all these other ones. So right here is how you compare these two. So our next one you can add one, the public company ends with LTD, and the private company is PLC. All right, let's input that right now. Okay, so that's our next distinguishing feature, limited. All right, and for the private, forgive the typing. All right, so that's our next distinguishing feature. So yes, we have covered companies, both private and public, and next time we're gonna dig into the franchise. Okay, the franchise is kind of long, and they have a lot of terminologies that you need to understand. So next time we're gonna dig into franchise. All right, so like and subscribe for more videos. Okay, I'm also thinking about doing some for economics and agriculture science. So stay tuned.